So Tim, what do you think of behavioral finance? Because it sounds complicated.
Yeah, I think I don't know what angle she'll take it at. Because the way you can look at it, like we always say, the market is the technical analysis is price and human emotions. You can take it from that end and describe how the emotions of humans buy and trade on the market. What emotions influence them to do that. Then also as a trader, as a person, how the market affects you emotionally and how you react that to your way of trading.
Awesome. All right, so I'm going to go ahead and, what time is it? 8:34. Okay, so I can do introductions and then we can get going. I see everybody's here. Oh, Kavi is here too.
Hey everyone.
Hello. Hi.
All right. Okay, so I'm going to introduce Timothy Kaminjo, one of our trainers and facilitators here. Timothy, you want to say hi? Then I can.
Yeah. Hello, everybody. How are you? As you heard, my name is Tim, one of the trainers and facilitators at PeteandPete Investors. I've been helping Pete with the training and preparing materials and also doing a lot of background work behind the scene. So welcome, everybody, and ready to learn.
All right, then let me also make an introduction to Teacher M. Teacher M has her own special corner in Discord, and she is a force behind all communication and Discord application, and notifying everybody what's going on. So Teacher M, can you say hello to everyone?
Yes. Hi. Hello everyone. It's my actual real name is Mogore. That's why I call myself M. And I'm a teacher by trade. Looking forward to leaving the school district very soon. Once I learn how to do investing from Webster here, I'm ready to stop using that chalk, man. But welcome everyone. It's good to have you guys in our community. And we bless God for this beautiful community that He has given us.
All right, thank you so much. At PJ Options should be here too. I know he had said he was going to.
Yeah, I see him. He's there.
Yes, Galaxy.
I'm here.
Yes, at PJ, go ahead and say hello.
Yes, welcome all of you. We are very glad that you are here, so that whatever you learn from Pete and Pete, you go and use the strategies that we are going to hear, the professional strategy we'll hear from our presenter today. So we are so glad that you are here, and we are looking forward to the people who are not yet members of Pete and Pete to come and see what we do, and just come and try and see what we do. And we welcome you all the time. And thank you so much, Njoroge, for this time. And welcome you again. My name is Peter Mwaura, and I normally teach options there. So welcome again, and I hope to see you sometime soon. Thank you so much.
Thank you so much at PJ. All right, Timothy, I made you a co-host.
Yes.
So go ahead, and if you're in a place that you need to mute your environment, go ahead and mute yourselves.
I think I've muted everybody.
Yes, thank you. All right, so welcome again. I'm going to make a formal introduction to Esther Hadassah Kamunya. She's in Canada. It's a pleasure to have Esther join us today to discuss behavioral finance. I met Esther not too long ago, actually, and we have, oh my goodness, it's been an awesome relationship, knowing her and discussing things. A lot of things we find between us are very common in financial world. Both of us want to encourage the community to do what's right with their finances, to get out of debt, to become financially independent. And those are things that are very dear to us. So I'm really glad that I found her and connected with her. And I asked her if she can discuss a little bit about behavioral finance. She's very good at this. She's a financial advisor, and whatever information she is going to share is valuable to our community. And I would ask that if you have a question, go ahead and post it on the chat. That way we can collect all the questions towards the end. I know she has a presentation to make. We'll allow her to do that and then ask her the questions later. Although if she prefers, if there's a question, if she takes a break and says, okay, is there any question, I can quickly refer to the chat and maybe we can answer it. So welcome, Esther. It's good to have you. You can go ahead. I think I have already enabled sharing your screen. You can do that. Welcome, Esther.
All right. Thank you so much, Pete, for inviting me. And I would say the feeling is mutual. Meeting you was a really good thing that happened to me. It's recent, but it feels like it's been forever. And so I am so glad that we connected, you and Mugore, and we share a lot in common, and we are in the same area of work, same experiences, and it's good to have people that you can work together and put your mind together and help the community. And so we are bound by the same, I would say, same passion, same commitment, same dedication to really help ourselves as we are also helping our community. And so I am very, very delighted to be here, to be sharing with you and the community and present this topic about behavioral finance. This is a topic that I have picked recently, and let me know if you can see my screen.
Yep, we can.
And it's in presentation mode.
Mm-hmm.
Okay.
Yes, it is, yeah.
Awesome, awesome. This is a topic that I picked recently. I started my financial services journey not too long ago. I started as an insurance and investment broker. And during my training as a financial planner, I found that this here is like, how do you say, the elephant in the room when it comes to finances. And so that's why I have made it a commitment to talk about this to everyone I meet. And I usually modify it to meet different needs. So I talk to my clients. Sometimes I talk to women group. And today I'm conscious that I am talking to people who are into trading and investing in the stock market. And so I have modified it to fit that community. And it's disclaimer, everything I'm going to present here is for your information. I do believe I'm a good financial advisor, but unless I work with you personally and we do some signing of disclosure and all that, please take this, everything as for your information and do your due diligence. A little bit about myself. I am married to Simon. Simon, we have been married for 27 years now. We have 2 adult kids, and we live here in Calgary, and we are so blessed. We have had, walked through life, ups and downs, and the ups have blessed us and the downs have made us better, and we have learned through so much experience. In my past life, this is what I used to do. My passion was about trees. My daughter used to call me a moth catcher or a butterfly catcher because I was doing research in forestry, in insect ecology. And I thought that everything that is wrong in the world can be fixed by managing the environment. Very passionate about that, still passionate until something changed in my mind. And I thought that there's so much research that has been done there about almost everything that you can think that ails the human society. But I found a common denominator, that the way we manage finances determines everything else. It determines relationships. It determines how we deal with the environment. It determines how we deal with one another. It's been said that finance is the #1 cause of divorce. You know, conflicts in finances. Then what is making our environment destruction is because of money, because we convert all our resources into money, and knowing how to manage those resources for the next generation, that has become my passion. So this is what I'm going to be talking to you today. I will talk about human behavior and how we make decisions. There's 2 systems of thinking. I will talk about that in how it relates to dealing with money. And I will zero in on some hard mentality, which I call heuristics. And then we will look at how to solve some of those mentalities. So here we go. I like to start with this. We are all climbing this mountain of life. And when we get to the top, it's beautiful. But remember that my top and your top, they are different. And so we have to figure out, what mountain am I climbing? And do I climb that mountain the way somebody else is climbing it? Or do I find my own ways of how to climb that mountain? So today, I know we are dealing with a community that is already invested in trading and investing in stocks, and sometimes there is confusion. So if I buy some stocks and sell, you know, I have a Robinhood account, I have a Wealthsimple account, am I an investor? This quote here is, I could not confirm it, but you guys can you know, find out who said this, but my understanding is Warren Buffett who has said this. And so we have to know, are we investors or are we traders or are we both? And there's nothing wrong about that. It's just knowing what we are doing at any one time. But before we get there, how does the human mind work? We would like to think that we are very rational. When we started this conversation, I had Pete and Tim talk about fear and all that, and all those emotions that catch us. You know, when you're going to place that stock and your hands are shaking, you're sweating. Why is that happening? It's technically, we would like to think we are rational beings, but we are not. We are very irrational. We are very unpredictable. We do not have set of rules to govern ourselves. We don't have them as a default. That's what I mean. We don't have set of rules as a default. And if we did, financial planning will not be necessary. Not even financial planning, any planning. Even if you're getting married, you know, if you followed your irrational, unpredictable behavior, you would marry the wrong person. If you are buying something, any decision you make, if you follow your human instincts, you would do so many things so wrong. Why? Because we are, by default, irrational. We don't always weigh all available options. We don't like to conduct rational analysis so that we can arrive to a good, optimal decision. If we did that, life would be so easy. So let's talk about how the mind works. How does the mind work? There's so many ways to look at this, but I would like to zero in into these very clear, identifiable systems of thinking. This is how people make decisions. There's system 1 and there's system 2. System 2 is the one that I talked about, default, like a child, is the most primitive way of thinking. This decision, it doesn't need logical steps. You follow emotions. It's very protective, and you like to dwell on the familiar territory. This is what I'm calling mental shortcuts. So picture this: when you're a trader and you're trading and you're wanting to place that trade and you have done all the technical analysis and everything you can do, still this kicks in. And when you're shaking, why are you shaking? It's because your system number 1 has kicked in. You would like to protect yourself. You want to protect your money. You don't want to lose your money. So when emotions kick in and outweigh all the other rational planning you have done, that's when you shortchange yourself and you make decisions that then you look, oh my gosh, why did I just do that? So that's what we are talking about. One of the biggest heuristics, one of the most common, is hard mentality. Now, during this pandemic, this word hard has become everyone's, everybody knows about how we have talked about hard immunity, hard mentality. What's hard mentality? It's group thinking. It's group thinking. And if you think about group thinking, it's how animals operate. Animals, like if you have watched the Great Migration of Masai Mara, the wildebeest and all the other animals, they have these instincts that they know that every day's time of the year, they have to migrate. And there's a leader of the animal. The other animals, they don't have to think, they just follow. They go through the river, they just jump in. Whatever the leader of the herd does, that's what they do. Same thing with these animals. When they have a disease, they don't think about how to cure the disease. They just allow themselves to be infected, and whichever dies, and the ones that remain, those are the survival for the fittest concept, that the ones that survive will have the tolerance against whatever was killing the herd. That's herd mentality. But we are human beings. Even though we have that tendency of system one thinking, it's a primitive way of thinking. We have another system of thinking, which is the system two. So if you think about system one of thinking as it relates to traders, people who are trading stocks, now this gets very interesting because this is where we have all kinds of things. We are living in internet age. Right now, everybody knows something about everything. That's why even in this pandemic, everybody knows how vaccines are made and whether they are good for you. And it's the same thing. Everybody knows which are the hot stocks. We have robo-advisors, we have Robinhood community, we have Reddit, name it. And people are trading and following the herd. Believe it or not, it's herd mentality. And that's why we had the GameStop, squeezing and all that stuff. Then we talk about bears and bulls. Then you will hear people say, oh, it's time to get out. It's time to get in. We are timing the market, the fear of missing out. These are our system one ways of thinking. This is why when you're sitting behind that computer, trying to trade and trying to make either, whether it's a long-term stock that you are buying, because of that system one of thinking, you will always have those nerves that want to protect you, those emotions that want to protect you. And then what happens when you think like you are following the herd? Now hear me, right? And hear me very carefully. Herd mentality gives us a sense of protection, that if I'm doing what everybody is doing, I'm okay. So we tell each other, we talk on Reddit, and we say, oh, this stock is the best, and you go for it. We have a community like this one, and you hear the teachers call this stock, and you go for it. And you really probably don't know what you're doing. And then the timing and all that, and you hear, oh, this person has this platform, is the best. I don't like this platform. But do you really do the system two of thinking, or do you just rely on system one of thinking? Now, if I buy stocks and sell stocks once in a while, if I keep them for 2 minutes or 1 year and then sell them, or 6 months, am I an investor? There's different ways of knowing this. To know whether you are an investor or a trader, you can rely on this. And if you are trading, you have to know, or to know whether you are a trader or an investor, or you could be both. But to know what you're doing at each specific time is so important. And believe you me, I have been there when I'm trading, but I'm applying my investing heart or investing mind and it doesn't work. Or when you're investing and you're basing it on your trading mind, it doesn't work. And so at every given time, you have to know what's your goal, what's your timeline, what do you do with your profits, what returns do you expect. I know most of you are taking notes, so that's why I'm leaving the slide a little bit, but I can share this. I can share this after the training, so you don't have to feel like you have to write everything. I want to focus on the returns. I really want to focus on that because hard mentality or mental shortcuts or system one of thinking, what you do every day and you're trading and you say, oh, let's say you're day trading, oh, I made 10%. And then over a month, you can track how much have you made. But there comes a time, and every trader will tell you this, will confess, that you can make 5%, 2%, 10%, and then one day you blow up all your account. And that's 100% loss. And you wonder, why does that happen? So even though trading, very few people, and it's so important to track your returns, to track what you're doing, to keep the records. That's system two of thinking, to keep the records. Because if you are just saying, oh, I made some money, I bought this stock. Sometimes I talk to people and say, I bought this stock at this much, but now it's this much. Does that mean you made money? If you were to analyze, you would clearly see how much your portfolio is making over a period of time. But if you just base it on emotions, on feelings, you will still be operating on those mental shortcuts. So how do you know? You know what? You could be a trader or an investor or both, but not everybody can be a trader. But everybody should be an investor. Everybody should be an investor. I repeat, but not everybody can be and should be a trader. But for you to know whether you want to be a trader or not, is you need to understand your financial goals, like we talked about, the timelines and all that. But you have to have this kind of appetite for fast thinking and ability to stomach swings, market swings, frustrations, disappointment. In other words, you have to have a thick skin. Like Pete was sharing when we were starting, that somebody entered some future contracts and they went to make some coffee because they didn't know how this trade was going, and coming back, they were losing 17,000. And the other way could happen too. You could buy a contract and coming back is 300% up. But if you were to tease out when these things happen or not, system one way of thinking will not help you. System one way of thinking is this: when you come back and see you are losing 17,000, now you are scared of entering any trades. Because why? You would like to protect yourself. System two way of thinking applies other tactics that I'm going to share in a bit. Now, if you cannot trade, you can be an investor. And just because you're in a community that you're trying to trade, it's okay to see and work out and see, am I really a trader? Do I have what it takes? Or am I just an investor? And you still can make money while investing. And there's other ways of investing. A lot of people who trade and invest in stocks, they have a negative attitude towards other investment. And also, a lot of people who don't trade and don't invest in stocks, they have a negative attitude towards stocks. But the bottom line is to understand that there's other ways of investing. Those who swear by the real estate market, they think it's the best way. You can never lose money when you buy houses or you buy land. Is that true? Statements like that, again, system one way of thinking, hard mentality, especially for us Kenyans. Not all of us are Kenyans here. I know I have a friend of mine who I invited here who is from Nigeria, but it's the same mentality. We think that investing back home is better. We can buy what we are comfortable with, but there's so many other things that we need to assess. I don't have time to dwell. I'm going to make another presentation, and maybe Pete will give me a chance to come and discuss this together with him in the forum, just about real estate investment, versus stocks, and investing back home and investing back here, and what you need to consider. Not hard mentality. Not this is how our grandparents did it, and so this is how we know how to do it. But what can you analyze? What can you apply in the system 2 of thinking that will help you make these decisions? I like to give this scenario. To me, knowing what to do really is like digging a well. For those of us who are Christians, we know this story in the Bible, where Isaac went into a foreign land, and he would dig wells, and the Philistines would come and bury the wells. And he kept digging and digging and digging until he found one. And digging wells, really, even in the present day world, requires a lot of assessing, geological assessments. And sometimes you can drill a well and it doesn't produce water. But what do? Do you say, oh, we will never find water, we just give up? No, it requires you to dig and dig and dig until you find one that works for you. Now, that's where system 2 thinking comes into play. It's logical, it's analytical, it's strategic, it's objective, it's not subjective. It's not based on what you already know. It's not based on familiarity. It's not based on emotions. It's not protective. It's really about, it's not survival. It's about, living in abundance. It's about doing the things that are beyond just basic survival. And this is important too, that I like to highlight this, that this system 2 of thinking is less emphasized mostly in our cultural and religious teachings. We are not taught to really apply system 2 of thinking. So what's the solution? How do we overcome system 1 of thinking? Remember, we have it. It's in us. But system 2 of thinking is something that we can develop. So how do we do that? To overcome system 1 of thinking so that it doesn't kick in every time we are making this hard decision, it's really to develop system 2 of thinking. How do we do that? I want to share some basic principles of building wealth. I know Pete has a very good presentation where he talks about investing in stocks, starting a business, investing long time, real estate, all that kind of things. Those are good. But I'm gonna base those now from a financial planning perspective and give you some basic principles that you could apply anywhere, whether you invest in stocks or whether you trade or real estate or whatever, how to bring it all together. Number 1, have a plan. This is a hierarchy of planning that I like to share. And if anybody who have seen this, you have seen this too many times to count. I repeat it because it's so important. It's okay to plan. If you plan, it's better to have a plan and fail than to fail without a plan. Because literally, if you don't have a plan, you are bound to fail. And this plan is very basic. The foundation is that we take care of events that are out of our control. How do we do that? Then we take care of things that are out and that we can control. How do we do that? And then taking advantage of growth opportunities. When we do this, we are able to eliminate things that steal our wealth. If you are to take this pyramid and remove the red part, something happens, the pyramid will crumble down. So it doesn't matter how much wealth you have created. It doesn't matter how much money you have made investing and in the stock market. If you have not planned well, everything will come crumbling down. And I always tell people that the number one resource that you have is yourself. Number two, risk management. This is the foundation. This having a plan is now how do you execute that plan? The first thing you need to do is manage the risk, the red part, events outside your control. So think about insurance. This is not an insurance training, but I thought I might stick this in here because the number one robber of the wealth that we create and we make is really those things that are outside of our control. And if we don't plan well, if we don't have those insurance in place to protect us when we are not able to protect ourselves, then that pyramid can come crumbling down. Now, if you are an investor, risk management of investing, there are so many things that I can talk about here, but the number one is discipline. Time is your friend when you are investing. The longer you are invested, the higher your risk tolerance. Why? Now, for example, you guys know that since around February or March, the markets have just been selling off. But if you are just investing for 2 minutes, you are done. If your mindset was, I'm gonna go trade for about a month and make lots of money and buy land, then you are done because your money right now is probably sitting at 50% loss if you didn't do things right. But if you have time, you have time for the markets to recover. So even when you're doing investments and trading, risk management is so important. Another way of risk managing is diversification. And this is diversification in action. This is an example of funds that I give to my clients. Now, if you guys are day traders, consider having some portfolios that are long-term. Some that you are not even the one that manage. Somebody else manages for you. Now, a lot of people who trade, number one reason why they trade is because they don't trust somebody else managing their money. But I'm here to break that tendency. I'm here to encourage you that it's okay to have some money that you're not managing just yourself. So think about it this way. If you have a job and you contribute to a pension plan, somebody else is managing that plan. If you have a 401 or in Canada, you have an RRSP, somebody else is managing that plan. It's so important that you have funds that are managed by other people. Why? Because you also are a risk. And if you are managing all your funds, what if something happens to you? What if those emotions kick in and you click the wrong button and lose all your money? What would happen? And number one rule of trading is don't trade with money that you are not willing to lose. So if you have your personal portfolio, this is something that you can apply to manage and diversify your funds. Make sure you are diversified across industries, across asset classes, geographically. You can have global funds, you can have US equities, Canadian equities if you are in Canada, all that kind of stuff, but also have funds that are being managed by somebody else. Risk management, system 2 thinking. Another strategy or another principle of building your wealth is invest in yourself. You are your biggest asset. And so most of you who are here, you are here because you are part of Pete and Pete Investors, options and stocks and futures classes. That's a really good thing. You are investing in yourself. I worry when I see people trading and they are only depending on somebody else telling them, buy this stock. I do worry about that. So when I meet my clients and they tell me they have a trading account, because I plan, and I don't discourage people from trading. I know there is some financial advisors who say, oh, trading is, you will never make money. And I don't do that. I do encourage people to follow their hearts and develop their skills. Developing your skills and doing it right, it's good. But depending on somebody else to tell you buy this at this time, this is your stop limit, this is when to get in, this is when to get out, not a good idea. If you're going to invest money and trade your money, please spend some money and pay for the classes so you can be better. And I know I'm preaching to the choir. Now, I will repeat this again, this slide about traders' hard mentalities, because again, we are talking about these things. If you do the things I have talked above there, if you improve your skills, if you do risk management, if you do all those things, that's introducing or developing system 2 of thinking. That's what will kill these tendencies of jumping into a stock because everybody is jumping into it. This confusion of wanting to time the market or fearing to miss out, that's what will deal with that. Next, system 2 of thinking, get some help. Now, a lot of us who trade, again, I will repeat, I understand that most of us who do this is because they don't want to trust anybody else with our finances. But again, I'm here to emphasize it's okay to get some coaching. It's okay to get somebody, a mentor, to work with you, a financial coach, a trading class. Therapy, if you have issues with debt, it's okay. There is no shame in that. Engaging professionals when you're looking for real estate deals, even in Kenya, just don't wing it. It's your money. The little money that you pay a professional, it saves you a lot of misery. How many people have lost money because of getting into bad deals back at home? Too many that to count. And I like to show this graph that when people engage a financial planner to invest and grow their wealth, they always turn out richer and wealthier than their counterparts who do not engage a planner. This is a study that has been done, and this is all system 2 of thinking. Why is it important to engage somebody else? Because it brings in objectivity. It makes you see things from a different perspective. If you're making your own decisions, you are in your bubble. So if you have your money, you have your $10,000 and you're wondering, where do I put this money? You will be in your bubble. You will employ your own values. I like to share this story where even now I have this conversation with my son about buying land in Kenya. And so we talk about, the money that I would spend to buy that land versus if I was to invest that money in the stock market. And I'm stuck with my value of land. I want to buy land, build a beautiful home, plant some trees and some avocados and mango trees and all that. That's my value. And so if I'm trying to make that decision, I'm in that bubble. And so I need somebody else to come and help me see other things that I'm not able to see for myself. I think I'm coming to a close so that we can have interactions and questions and all that. But I will finish with this. It's your mountain. It's your financial future. It's your retirement. It's your wealth. It's your children, your inheritance, your generations. You do not have to do things according to hard mentality. Find out how you can develop a system 2 way of thinking in your own system, in the way you do things based on your needs, on your goals, on your dreams, and then apply it to yourself. It's okay to listen to other people, but at the end of the day, you need to put all these things together and see what applies to you. And with that, I am so thankful for you guys for giving me those few minutes to listen to me, and I will be happy to take some questions and to have a conversation. I always like, that's the favorite part, when we have a deep conversation about these things. Thanks, Pete. Back to you.
Awesome, awesome, awesome. Oh my goodness. I took a lot of notes here. I already filled up my page and I don't even know where to start. I know there's a lot of questions from a lot of people. The crowd is huge, and hopefully you got to jot down a few questions that you may have for yourself or from a friend, which is okay too. But I put in a lot of notes here, and I was looking at that slide, Esther, about the bad news is that the deer did not have insurance. Can you talk about that, deer?
Which one is that?
There's a slide, if you go back.
Let's do it.
There's a slide about, I think it's an older couple that is, I think they had a car accident or something.
Yes, the insurance one.
Yes. And I don't know who's asking that question really, whether it's, yes. peace of mind. so
Oops. Oh,
I don't know whether it's the insurance guy or someone that's sympathetic and is asking, whether somebody was prepared in this case. And I think that's the whole point about the
peace of mind.
Yes, yes. Whether somebody was prepared for what to expect, because anytime you put money to work, you, like you said, you need to have a plan. You need to have some kind of understanding of what's going to make you peaceful, because that's a whole goal. That's an awesome analogy, the deer.
Yes, these people, if they had an accident, and thankfully they didn't die, but they had insurance, and we all have insurance for our cars. And this is a conversation I have with people all the time. Insurance, auto insurance, home and auto insurance here in the US, in Canada, in most developed, even developing world, even in Kenya, it's mandatory. You cannot drive a car without auto insurance. And how many people get into accidents? How many people claim that? Very few people, but it's mandatory. And it's mandatory because the government has realized the costs of when those accidents happen can be detrimental. And not only to the person who was in the accident, but it's a domino effect. So many people get affected if there's an accident, if it's fatal, if it's all that kind of stuff. But we all pay auto insurance and we never even think about it. But because we are forced to, we do. Same thing with home insurance. Because we are forced to, we do. But when it comes to life insurance, most of us say, oh, I don't want to take a life insurance because it's a ripoff. And that's why I brought this scenario here. It's a ripoff because especially if I take term insurance and I don't die, then insurance will end up with that money. But this is the other way to think about it. If you had died and you are the greatest asset for your family, you would have been covered. And that's the logic behind that. So the logic behind these people is that if something had happened to them, they were covered. Unfortunately, it's a joke. The deer wasn't covered. But what is the risk? Who is affected by the loss of the deer? That's how to think about it. But who would be affected if this couple died or if one of them died? So it's really a mental thing to make it, show how insurance is important. It's cheap, but it's a way to risk manage your wealth, to cushion your wealth against risk. I always tell people, you are your greatest asset. If you go to the grave, let's say you are a young man, 30 years old, you make 100,000 a year, multiply that with the number of years you are left to work. if you died at 30 or at 40, you go to the grave. People always say that the grave is the richest place. Why? Because people are buried with ideas, with good intentions, with good stuff they never said, but also they are buried with a lot of money, income potential, business potential, all that stuff. So that's why it's so important to manage those risks.
Exactly. All right, so we can take a few questions. You can go ahead and post your question, or if you're ready, ask Esther whichever question you found during presentation on any slide between trading, investing. She has talked about a lot. So go ahead. If you have a question, unmute yourself and just ask the question.
Mine is not a question. This is Ralph. Thank you very much for the presentation. Just always a beautiful thing to be in this community of investors. Thank you, Pete.
Oh, thanks, Ralph. Welcome.
Yeah, I just walked in when the conversation was going, and unfortunately, I didn't look at the timings properly. I actually went in at 8:30 in the morning, only to realize it was going to be this evening.
Okay.
Yeah, but you said there's going to be a recording?
Yes, there's a recording, and the presentation she has offered is going to be available to us too. Yes.
Thank you so much. Thank you.
Yes.
Okay.
All right. Thanks, Ralph. Any other questions that somebody has between trading, investing, mental heuristics, system 1, system 2? You must have taken a few.
This is Alice.
Yes, Alice, go ahead.
Mine is not really a question, it's a comment. Also like Ralph, I think I'm so eager to learn about or to hear today's presentation that I almost logged in the morning. I woke up very early so I don't miss it.
Okay.
Now, my take home on this one and something that stood out, is about the comment on having other people also advise you or even invest on your behalf, rather than you're also a risk to yourself in that you may not know everything. And I thought that was something I never really thought about, that I don't know everything, and definitely using other advisors and also diversifying my portfolio is a key area. Yeah.
Correct.
So thank you about that.
Correct. And that's a very good point. I was talking to one dentist at one point about investing and trading. And he told me, I do not trade at all. And I asked him, why? You are able to do it. He said, no, I know myself, very emotional. I just do real estate and I give money to a financial advisor, because if I buy something, I have to keep checking on the phone 50 times a day and it drains me. I can't do it. So understanding yourself, to your point, Alice, is critical, knowing who you are and doing what's best for you. I actually like that comment Esther made. Not everyone should be a trader, but everyone should be an investor. And investing is very different from trading because you're thinking long term. Awesome. All right. Any other comments?
Yeah, I will make a comment too about that, Alice, what you just said and picked up on that. I'm so glad that you picked up on that idea of using other people to help you manage your finances actually as a risk management strategy. It's a risk management strategy because if all your money, you are the one managing it, there's so much risk that you have just exposed yourself to one manager. And if something happens to you, then everything is gone. And the way to think about it, I like to tell this story about my grandpa. My grandpa, now I know, after he has already died, I know he was very wealthy. But before he had died, I did not know he was very wealthy. I thought he was so poor because he never told anybody about what he was doing. Maybe he did, but those days, as gentlemen who are here, those days, women were not being told stuff those days. I hope you guys have changed that tendency. Men never shared their secrets with anybody. Women and children were not to be told anything. And so my grandpa had these investments of land that even people didn't even know that he had land here and he had land here. And he used to walk around like a very, very poor person, wearing very old clothes, you know, with those color shoes, the ones that you make from the tires of cars, you know, those shoes. You guys, I don't know if you guys experienced that, but you know, I grew up poor. And now to think that my grandpa left land that was millions and millions of Kenya shillings is mind-blowing. But the problem is that land he left us, he left his children, and they are going to inherit that land, but they don't have the knowledge and skills of what to do with that money. They have no knowledge and skills. If my grandpa had involved somebody else to help him manage his finances, maybe he would have bought some stocks. Maybe we would have been owning like some, you know, Kenya Commercial Bank stocks or something like that. Maybe he would have written a will and know like, I need to leave wealth not only to my children, but only my grandchildren. He left me nothing. He left his grandchildren nothing. Maybe he would have given us some education. I am lucky I got educated, but the rest of my relatives, nobody has an education. So those are the kinds of things I'm trying to teach our community. Let's not hold on to, sometimes we think we are holding on to what is ours. We don't trust anybody else. We don't want to lose it. But the more you hold on to it, the more likely you are going to lose it, or the more likely you are going to miss opportunities to multiply it 100 folds, 1,000 folds, because you are too protective. That's system one of thinking.
Wow. All right.
Esther, I have a question. And my question really is, when you advise your clients, and I know Peter and I did a budget workshop, I think it was a month ago or so. Sorry, guys. But when you advise your clients, are there things that they should do first before even investing in the stock market? Is there like a hierarchy of things? Maybe you should share that with us and maybe help somebody so that they don't start with the stock market.
That's a really good question. Thank you so much, Teresa, for that question. It's actually nobody has ever asked me that question. I do that with my clients, but in a group of that, like this one, nobody has ever thought about that. And that's a brilliant question, because there is a way to do things. And if you think with that pyramid that I showed, usually what I do with my clients is I draw that pyramid and then I draw it upside down. Because when people go to trading and investing and buying land, when they have not done you know what, I'm just gonna share it because I'm a very visual person. So I really do like to, so where is the pyramid? Oh, there it is. There is the pyramid. I usually draw this pyramid on a whiteboard, and then I draw it upside down. And I show people, if you start here on the green part, it's like building the house from the roof up. Can you do that? Can you really build a house and start from the roof? It's not possible. But sometimes, especially us Africans, we tend to build our house from the roof up, our financial house. We go to buying real estate, we go to buying stocks, trading stocks, and it's really thinking in system one of thinking. Some of us who have those tendencies are those who did not even start investing sooner. And that's the catch. When I meet older clients, I talk to them, I try to encourage them, it's never too late and all that, but really, sometimes if you start early, it's better than if you wait too long. And when people start early, they have time and they can plan well. But if people wait too long, that's when they feel like they have to start from the roof. So if you didn't dig the foundation, you didn't do that. Now you feel, oh, this house has to be built very fast, so I'm just gonna go and do the roof. Wrong idea. Even if you're starting at 40, at 50, you still need to do this for the plan to work. So how do I do that? How do I approach with my clients? I have a very, very systematic way of doing things. When I meet my client, the number one thing always is to listen to them. They tell me where they are at, what they have going, what their plans are, whatever, and then I do a value proposition of what I can help them with. And I said, you said about this is what I can help you with. Not the solution, but what I can help them with. And then we gather information in detail. And before I offer any solution, we go through that cash flow. The one you talked about, budget. We go through cash flow, because if I tell you go trade or go buy stocks or buy insurance, with what? I need to understand your cash flow. I need to understand where your money is coming from, how much is coming in, and how you are spending it. And then that's where we start to find if there is any things that we can take advantage of. For example, are you a big spender? Then we can deal with that. Are there some places that you are spending based on heuristics? Because heuristics is not only investing, it's also spending. I remember Mogore giving stories of how before they started this adventure, how she had big credit card debt. Let me tell you, Mogore, you are not alone. A lot of us, and it's not a shame. I had huge credit card debt. For me, my weakness is giving money. Giving money. Every time I hear there is a problem, there is a fire, I am there to put it off. I give until I can remove my own clothes and give and remain naked. That's the mentality I had, attitude, like a really bad attitude. And when you do that, you have to look for loopholes. So when I talk to my clients, even the money you send to Kenya, the money you send to friends, that one I put in there so that we can track it. And then we look at opportunities where we can maximize that cash flow. Then number 3, risk management. We always start with the insurance. And people come to me with all kinds of mentalities against insurance. And I listen to them. You know why I do it? Because I was once like them. I tell this story of one time an insurance agent came to me to sell me insurance, and they were very nasty the way they approached it. And I told him, where I come from, we don't believe in insurance. We believe in God. That was my mentality. I never wanted to hear anybody telling me about insurance. I thought this was a ripoff. I thought they're just selling things, but I wish I knew. So today, because I understand, I take time and explain to people why it's important to risk manage. But on the other hand, I don't oversell insurance, because I have found other cases where people have been oversold insurance. They have been told you need this and you need this. I base it on the cash flow, and I base it on the need of the person and how much they can afford, and not compromise investment, because we can't buy insurance and then we don't have investment in education. We don't have investment in retirement. We are not investing in emergency or paying up debt. No, we can't do that. That's the kind of process I follow. And then after that, now we can talk about trading. Now we can talk about, those other things, buying stocks after you have done that. So your 401k for you guys in the US is the orange part. I don't go to stocks. Stocks for me would be green. If you have not done the orange part, you don't have your 5, whatever you call it, for the education for the kids. You don't have some retirement savings somewhere that is being managed by somebody else. If you have not taken care of the orange part, and I have been able to convince my clients not to discourage them from trading, but tell them, do this first. And they see the sense. Then if they go to trading, here is what I also tell them, take some classes. So I send them to Pete. I hope they will come, because I tell them, I ask them, how much money do you have in a stock in your trading account? I have 5,000. So what are your goals? What if you lost that? And sometimes I have been able to convince people, and they are telling me, yeah, I will consider that now. First, stop trading, take some money, $1,000, invest in a class. When you come back, you will be a better trader. So I hope this is answering the question. That's the kind of a process, and it's different for everybody. So I do have a system, but then I deal with everybody from where they are at, because I have to consider what they have grown up thinking, because I was there. I'm still there. I have some hard mentalities too. And sometimes when I'm talking to people, I'm also talking to myself.
Awesome. Thank you. All right, Esther, I have a couple of questions here. Thank you for that answer. Very good. Very well said. Judith is asking, how do we avoid advisors like Bernie Madoff? We remember Bernie Madoff. How do we avoid those kind of guys?
What did Bernie, what happened? What's the story behind Bernie?
Bernie
What is it that?
Yeah, he was a hedge fund manager.
Yeah.
And he was collecting money from unsuspecting investors or traders, and his portfolio was perfectly tuned so that every quarter it's showing huge explosive growth. And those were just spreadsheets that he would print out. Not necessarily that's how your money is working. And a lot of people put in money, because if you giving somebody money to invest for you, and every quarter your money is growing exponentially, 10%, 20%, 100%. So a lot of people invested with Bernie, only to realize that it was a pyramid. There was really no setup accounts, and he ended up in jail. So how do you avoid those kind of people?
Yeah, it was more of a Ponzi scheme. Yeah.
Yes.
So the number one thing, that's why even what I presented here, I said, do your due diligence. So even if I came here and I said that I was a financial advisor, it's still up to you to do your due diligence. Search me out, talk to people who I have worked with, and see what kind of a person I am. Now, Bernie Madoff was like a celebrity kind of a case. So I want to believe that the people even who invested with him were not small people. It's people putting a lot of money and all that. Now, for our community where we are, like low to middle to, that kind of net worth. No, I don't know if there is very, very high net worth people here, but those kinds of people, we have ways of dealing with financial advisors. And again, is do your due diligence. Most financial advisors like myself, I don't manage the money. So I am just a pipeline. So I will deal with insurance and investment companies. And so you need to do the due diligence of what I am telling you. So if I say I'm going to invest for you in this company, maybe these funds are managed by Fidelity or by CI Investors or by TD Asset Management, then you have to do your due diligence. But remember the digging the wells. Sometimes in life, you really do have to dig those wells. And unfortunately, sometimes you will go somewhere and something doesn't work out. And I give this because even for me, there are some things in the past that stopped me on my tracks because I had a bad experience. And because I had a bad experience, I say never again. But I realized if you dealt with a financial advisor and you lost some money, and now you hate all financial advisors, guess who is the loser? You are the loser. And I know that from experience. Because when I did not want to hear anything about the insurance agent, or the financial advisor, then I did not want to hear anything about that, and I stayed in my ignorance. Some people think going to robo-advisors is better. It's not, because even on the internet, there's a lot of garbage there. So you know what? Who asked this question? I don't know who asked this question, but this is a good question, but there's no straightforward answer. The answer is just as dirty as the game. Is that at the end of the day, do your due diligence, dig the wells, trend carefully, and you will be okay. Most people don't lose. Most people, if you do the analysis, most people do well. Otherwise, we would have very, very poor people around. We know we have retirees here who are doing well, they invested, so most people don't lose. And that can be comforting, that if you do your due diligence, you will not lose.
Right. All right. There's another question here about, maybe I can answer this one. I thought she focused on the second system of thinking, and you're trading and investing, and I think he's saying that you still have handshaking before you put a trade, and you're fearful on what happens to it. How can you really limit or eliminate this issue? And I can tackle that one. Whenever you are going to trade, particularly if it's a short-term investment, and you have defined your risk to reward ratio. So you had put in, let's say $1,000, and you have figured out that I'm going to buy, whether it's Baidu, Alibaba, whatever it is, and you are going to only lose $200. That's your risk. And your expectation is that you will collect a 3-to-1 ratio, or 5-to-1, 7-to-1 risk to reward ratio. So you cap your losses, you define it, and then you let go of your trade. And usually we have, every trade has 3 elements. There is a stop, there is an entry, and there is a target. Once you put those parameters in your short-term trade, you are done. Because all you have to do after that is manage it. You know your risk. This is how much I can lose, and this is how much I can make. That's it. Now that eliminates your handshaking and what you're going to do about this trade. You have defined your parameters. And that discipline is what most Wall Street, they know how to manage that risk. And that's the same thing you should do. Have a plan, be very disciplined when you put these kind of short-term trades. And I found that to be a system that most professionals work with, and they let go. Once you lose whatever amount you had put in, let it go. Go to the next one. Figure out about something else. All right. There's a question for you.
I will add something to that, Pete. If you know, what you just described is system 2 of thinking. So if you look at this graph, and on a day on the market, when the market is just doing this, and you entered a trade, let's say you came here and you thought 17 was your level to continue go bullish, whatever, for whatever reason, this stock will keep going up. So you just enter a trade, and then it turns around and does that. So if you use system 1 of thinking, you see all that red, now you are emotional, you're shaking, you don't know what to do, and you will make every single wrong decision. But what you just described is system 2 of thinking, is before you enter a trade, you have defined your parameters. You have rules that you always observe, because you are a rational being. Do not ever trust that you are rational. But if you have those systems in place, then you will be able to avoid that handshaking. The other thing I would like to emphasize is a lot of people go into trading, but they don't paper trade. Paper trading before you start real trading is so important. And paper trading also when you do real trading is so important, because then you practice your skill. I had this conversation with my son a lot because he likes to trade. He has good adrenaline and all that, but it's not only that you need. And so when he doesn't practice, he didn't understand the importance of practice. And so I'm a football fan. So I tell him, if you are a quarterback and you have had a bad game and you lost so much, you could not throw a catch, do you really think that if you go and don't practice before the next game, you will improve your game? If you go and watch YouTube videos, because that's what most people do, they just watch YouTube videos of people trading, and you think you are learning. The best way to learn is to learn by doing. And how best way to do it than to paper trade and learn? If you have a losing streak, take a break, go back to paper trading and see where you are going wrong.
Correct. Very well said. All right, a question for you, Esther. Are you fiduciary? I don't know what that means.
Fiduciary means that when I do my advising, when I offer my services, that I keep my clients' interests above all else, including my own interests.
Correct.
So am I fiduciary by practice? Yes, but I am not legally fiduciary, and I will explain. Okay, so I know in the US, all financial planners are they can choose to be fiduciary or they may not be fiduciary. I think it depends with what certification you have. In Canada, I am going through the certification process to be a certified financial planner. But even if we operate by practice, by being fiduciary, in Canada, legally, we are not fiduciary. I don't know if that answers your question. We have, FP Canada has guidelines or terms of engagement or all that. So it's almost like trust that it's left upon you as a financial advisor to apply those guidelines. And you could be sued for breaking those guidelines, but not because you're not fiduciary or whatever, but because maybe you compromised your client trust, but really not legally fiduciary. I hope that answers the question. Does that mean I put my interest above my clients? No. I always disclose, one of the disclosures I do with my clients is that I will do due diligence to make sure that everything that I'm doing will be beneficial to them, which means I keep up, I study, I am knowledgeable, I interact with other FPs so that at least I can offer good services to my clients. Number two, confidentiality, that whatever we discuss with the clients, it remains between me and the clients. And number three, fiduciary from practical perspective, that I will keep their interests above all else, including my own interests.
Good. Awesome. All right. You have another question here. And I think this goes back to one of the slides you had about asset allocation. The question is risk management. What asset allocation do you typically use? Is it 60% stocks, 40% bonds, 20% cash? I think that's the question they're looking at, risk management. How would you do an allocation? Because a lot of people, when they buy stocks and it dips, they no longer have any money left to do anything. So that means there's no cash allocation. They have used all of it up.
So asset allocation, the way I do it for my clients when I'm managing money that I give to other money, like portfolio managers, asset managers, like Fidelity or, CI investors, I do based on the client. So there's no asset allocation that fits everybody. And the determining factor is the risk tolerance. So I know you guys have you have gone either to your bank or whatever, and you are told that you are placed in a balanced portfolio or a growth portfolio or an aggressive portfolio. So based on your risk tolerance, then there's predetermined asset allocation. And the way it goes is that if you are low risk, then we don't put you 100% in equities. So we will have a bigger mix of bonds. Maybe we'll have 40% in bonds and 60% in equities. And then those equities, maybe we will put more equities in, if you are in Canada, in Canadian and US equities, other than global equities, you know, because they are more volatile. But if you are an aggressive investor, then we could have like a 10% bond allocation, and then the rest in equity. If you are managing your own portfolio, like seriously, if you have a $50,000 account, having all your money invested in stocks is a very, very bad idea. No matter how good you are as an investor. Even those portfolio managers that we have, they have cash. And the reason for putting cash there is because, number one, you can have a buffer in case some trades go wrong, some investments go wrong. Number two, you are able to take advantage of new things that come up, you know, and you have room to rotate your investments. So the short answer is asset allocation depends, but there are rules. Now remember, the people like Fidelity, they actually use mathematical formula to do those asset allocation. They even do correlations. They do standard deviations. They do all that. If you have your own portfolio and you buy stocks that are correlated and you think you are diversifying just because you bought 10 different stocks, but all those stocks are tech stocks, what happens if the tech goes down? All your money goes with it. So diversification is not just buying different stocks. It's also knowing how to deal with correlations and autocorrelations and things like that. That's why the question that I don't remember who had asked that question that I liked very much. I don't see them here anymore. Having some of your money being managed by those experts, it doesn't hurt, because they have more advanced ways of managing those portfolios.
Okay, you have another question. I love this question. Love it. So how do you counter a need to liquidate your investments in case of an unexpected financial burden while investing long-term? So you're thinking you're investing long-term, but then you have an unexpected financial burden and you get this need to liquidate your investments. How do you counter that in terms of system 1 and system 2?
Yes. It's a very, very simple, yet so complicated. It's so simple, but yet so complicated, because if we understood the simplicity of it and implement it, we will probably never find ourselves in such a situation. Number one, risk management. Why do we find ourselves in those places, in those times, in those seasons when we need to liquidate? Because we did not have a plan to risk manage. We put all our money in the stocks. We didn't have insurance. We didn't have living benefit. So the worst could happen is you're diagnosed with a disease and you can't work, and now you have to liquidate. Or you had taken a debt and you had not taken insurance to cover that debt in case something happens. Risk management is the number one way to avoid that. Maybe you didn't have an emergency basket, you know, so that if your furnace breaks, then you have some money to do that. Why we need to liquidate some money is because we did not risk manage. We didn't plan to manage the risks. And we are notorious for that from where we come from, aren't we? You know, in Kenya, a lot of wealth, and I believe in Africa, has been lost because of those things that are beyond our control. Somebody gets sick and we have to sell everything. I would like to submit to all of us that for me, the reason why I feel like I'm not in a good financial position is because almost a big chunk of my income, I'm always using it to take care of those risks back at home. How many would identify with that? Like always, somebody is sick, somebody needs to be bailed out, somebody needs to go to school. Because we didn't plan how our kids will go to school, then now we have to liquidate assets. So the number one answer really is risk management. And then top layer of that is financial planning and financial advising. Because if you don't plan, if you don't have a financial advisor, you will not take care of those risks, guaranteed. You know why? Most of us don't like to think about death. We don't like to think about bad things happening. So let somebody else think about that on your behalf and help you plan for those things. I hope that answers that question. But I think it's as easy as that. Risk management, planning, and financial advising.
Cool. All right. Very good. All right. So there's another question here from Annette. She joined a little late, but the question is a good question. Whether we guide stock traders in Kenya. A lot of people in diaspora don't have a clue about portfolios that they began or they want to establish in Kenya. And that's a very good question, because actually next Saturday, we have a special session for our members in the community on how to invest in Nairobi Security Exchange. And we have a great resource through Abojani community. His name is Robert Ochieng. He has built a wonderful community of investing in Nairobi Securities Exchange. He's one of our consultants at PeteandPete Investors. And every month, he'll be doing a class on how to invest in Kenya, giving us guidance, CDSC, what should you look at? A very wonderful individual that is fully invested in that stock exchange, has a lot of knowledge in it. So you may want to go ahead and RSVP on your app, on the Wix app, or just send us a note if you don't have the app with you to attend that class. It's a free class for the community and for our members. But going forward, every month he'll be doing a class for everyone in our community. So a wonderful resource. Just come over, you will get all the answers you're looking for. And he actually posts on our Discord app. He has a specific channel there, Nairobi Securities channel. Every day he will post wonderful events. For instance, StanChart declared 10 shillings dividend. Now, if you had bought shares for StanChart, 10 shillings that's a lot if you had 1,000 shares. And he posts a lot of information for us. So go ahead and RSVP for that event next Saturday.
Peter, can you also let Annette know that we have started a relationship with some banks in Kenya regarding?
Oh, yes, correct. Yeah, we do have a relationship with NCBA, the brokerage firm in Kenya. I'm also working with a contract with Suntra. Those are brokerage firms. And what we have realized is that a lot of us get frustrated dealing with all these firms. We don't know whom we are talking to. Just having one person that we can contact and tell them, where is our portfolio? What can I do? So Samuel Geshohi will be coming later on towards the end of April for a special session too on what they do. And he will guide us. You can log into the portal at NCBA online. You can see your portfolio. You can buy and sell equity, KCB, Safaricom, while you're here. You don't have to travel. So these are resources that they have always been there. It's just that our community never accessed them. And that could be a very good way of, if you're thinking diversification in terms of geography, that's a country that is still growing. Safaricom started at 5 shillings and 5 shillings, I don't know what that is in terms of dollars. And now it's at 38 cents. It's still a penny stock. But you can imagine Safaricom, as huge as it is, it's still a penny stock. And if you're going to put $10,000 or whatever amount of money, it has very good dividends. So yes, we do have that relationship with, and these are things that we'll keep communicating with our community, engaging them. That way they know that, you can do this. It's not really rocket science.
And one more thing, Peter, before you go. Part of Esther's presentation and part of Esther's financial planning, it also includes how many of us have stocks in Kenya you bought or you asked somebody to buy for you and you have no idea where they are. You've never collected dividend for maybe 15 years. You do not even have a CD, what is it called? CDC? Yes, account. You have a lot of, back in 2017, I went to Kenya and I had to go to this place in Westlands where you have to go and collect and claim the money. Do you know how many checks of mine were there of dividends that have been sent to image registrar and then they bounce because they wrote my US address wrong? I know there's many of us probably even here who have who bought a lot of shares and you bought a lot of land in Kenya and you have no clue where those assets are. Have no clue where those assets are. So a nice challenge here.
Okay. We have another question. This is a good one. It complements what Esther has been talking all along about financial planning comes before investing. Thinking about that pyramid that she had put up on things that you should do first before you even think about buying stocks. Now, the question is, and I think this is for you, Esther, in Canada, because you can answer this question. How much access do your clients have to you as the advisor? Some advisors take so many clients and then their availability gets close to none. So they just want to know, what kind of advisor are you, Esther, in Canada?
Oh, wow. So yes, so the first statement, it's true. Yeah, I would agree with the fact that financial planning comes before anything really. Before you decide what to do with your money, have a plan. The analogy I like to give is if you want to go from one city to another. So let's say I want to travel from Calgary to New Jersey. I have to make a plan. I can go to the airport in Calgary International and board any plane and hope it will land me to New Jersey. That's what, without a plan, that's what we are doing. But if you make a plan, you find out, which tickets are cheap, where is the plane flying through, what's the best time to fly, all that kind of the good stuff. That's the plan. When you have that kind of a plan, your chances of getting to your destination are almost 100%. Unless something really bad happens. Now, most of us fear planning because we fear to fail. But realize with a plan, you're almost 100% guaranteed you will get to your destination. So think about that. About financial planning, yes, I am only right now, I'm licensed in Canada. I really do look forward to one day, maybe I'll be able to work across the border, and I'm working on that. And it is true. It's a very, very strenuous job, especially for someone like me who likes to talk. And I like to come to things like this. That's where I find most joy. When I meet with my clients, I like to talk. We chit chat a lot because the more I chit chat with them, the more I understand about what we call their goals, their pain, and their gain. I have to make sure I understand that. What is it they are struggling with? What are their goals? What will they gain from my planning? So when you see how I approach even a conversation like this, then you do understand what kind of a planner I am. I am not hasty. I'm very intentional, and I am coming to a place. Now, you have to remember, I first started just as an insurance and investment broker, just like any other person who goes around, selling insurance and all that. Nothing wrong with that. It has its place. But I quickly realized that I am better off doing something else. I just didn't want to go sell insurance and not dig deep. I'm a very analytical person, so I take time to analyze things. So the best way for me to fulfill and to serve myself and my attributes better as a financial planner was really to advance and get that certification for financial planning. And you are right, it can be very, very strenuous, and getting too many clients can be really, really detrimental. So right now, I'm just at the start, but I'm starting to feel the burn. And so I'm actually planning, because you guys know that a prophet is never heard in their own city. And I'm going to say this right now, is that a lot of times I want to serve our community. But if they don't hear me, I'm going to close the doors, because I cannot serve too many clients. That's a fact. I cannot serve. If I take too many clients, I'm going to burn. So I'm starting to a place where I'm really talking to people and telling them, if you want me to work with you, this is the time. Otherwise, I may say I am full. However, I can always refer, especially if you're in Canada and I'm full, I'm not there right now, I can always refer to other financial advisors that I work with. I work in a company where we have good values, we have other financial advisors, and we can always distribute clients. So that's how we manage the workload.
Okay. All right. Awesome. Let's see if there's any other question. All right. I think we have satisfied a lot of people's questions. We are going to post our website for those that want to learn a little bit about what we do. I'm going to post our website there, and those that may be interested in taking classes, understanding this whole other world of investing and trading and shaking hands and fear and greed, I'll post our upcoming schedule for classes. You can definitely look into it. And I hope we have answered a lot of questions that you may have had about trading and investing, system 1 and system 2. Putting your mind in a situation where everybody needs to be an investor, not just a trader. And Esther has really touched on a number of things that we should pay attention to. All right. Let's see. A little later, I was wondering if taxes were covered. Yeah, okay, so this is a question about taxes. What do clients keep after taxes and fees? So we had a session last week on taxes. I don't know how you missed that one. On when you invest in the stock market, we had a session last week through a CPA on taxes. We can share our recording on that one if you're looking at answering some of those questions about taxes. We can definitely do.
I think he means if you are working with a financial advisor.
Oh, okay, all right. Yep. So how do you tackle that one, Esther? If you're working with a.
So if you are working with a financial advisor, tax planning is part of risk management.
Okay.
So again, this question and the previous one by Kellen, he's asking about the percentage to allocate to emergency versus investing. But really, these two questions depends with the client, both of them. So even how you deal with tax planning will depend with the client. But there are some basic principles, basic rules that I try to observe. So for example, a lot of you know about using universal life for tax planning because you will have tax-free benefit. It's been sold a lot to a lot of us. But I always tell people, think about it. If you haven't taken advantage of your 401 and your Roth IRA, like those tax advantage accounts, registered accounts in Canada, we have RRSP and TFSA. If you haven't taken full advantage of that, you don't need any other tax planning strategy. Those are usually enough for most working class. If you have extra money, if you are in the high net worth situation, then we can look for other tax planning situations. But a lot of people say you will defer your tax, but then you will pay later. True. But if you are making $100,000 a year now, and you contribute to your 401, you save on taxes because you reduce your tax load. When you retire, your income will not be 100,000. It will be probably 20,000 or 30,000 because you don't need much. The income you will be drawing from your 401k will be like less than a half of what you made on your highest earning years. Then you will be paying very little taxes. Net, you will have paid less taxes over time, throughout your lifetime. So those are the math that you need to do. If you do your tax-free, I think it's the Roth IRA, you will never pay taxes. So for example, if you're working with an advisor and I put you in a portfolio in your tax-free savings account, you will never ever pay taxes from that account. That's how tax planning works. If I put you in a retirement account, you will pay less taxes when you retire. Here in Canada also, we have RESP, it's an education account. I think you have that in the US. If you as a parent contribute to your kids' education in that education account, yes, it's after tax money, it will grow a lot, especially when you start when they are young. When they remove that money when they are going to school, they will be taxed at their tax bracket. So it's less taxes. Those are strategies that work depending on each person's situation. But those are basic principles. And then I sit with my client and I find what can they take advantage of. It depends with their cash flow. It depends with their net worth.
Good. All right. Okay. Very good. Thank you, Esther. Let me turn this now to Teacher M, Teacher Mugure. If you can talk a little bit about Pete and Pete Investors, what we do, our classes, I'll just give you a minute, go over that session, and then we can call it a night.
Right. So we are coming to the end, and we thank all of you who came in. I know we've done a lot of events, and we always look forward to educating our community and being part of this community. And we thank Esther. Ever since we met through Focus, we have been in a good journey together of educating one another and learning from one another and growing together. So that's part of our mission here at Pete and Pete Investors. Really, our goal is to do like Solomon in the book of Proverbs. A wise man leaves an inheritance for his children's children. And because I know for sure, Peter, my husband, and I, and almost, or maybe majority of you did not get anything from your grandfather or grandmother. So we are trying to make you better grandparents, maybe 20 years from now. For me, maybe 10 years from now. We want you to be better grandparents so that you can leave an inheritance for your children. So at Pete and Pete Investors, what we do, we have created a community of like people with the same mindset, and most of you here are in our group. But I know there is also people who came in here, like somebody just sent me a message that she learned into us. She doesn't know us. So we offer courses in stock trading. Our next class is starting the first week of April. And we offer courses on stock trading and options and futures. So we have 3 courses that we offer, and we also offer one-on-one instruction. And we also have a community, a small community in the Discord channel where if you don't want to take a class, but you just want to be part of us, you can join us for a membership of $99 a year. So you're welcome to be part of our community. And if you don't want to be part of our community, that's perfectly okay. Just tell somebody else about us. If you can tell somebody else about us, we will be grateful. And if you offer services that you think can help our members, like if you are a life insurance producer, if you are a financial advisor like Esther, if you fix cars, and that can help us, we will create a directory of people that we trust that we can always refer to our community. So let others know there. We have a website, and they can go to our website and get to know what we do and the services that we offer. I'm so sorry I'm talking like this. I haven't been well, but I am getting better. I have become very well now. So I thank God. Right, that's it, Han.
Thank you. Thank you very much. I want to take this opportunity to thank our team members at PJ Options and Timothy for always what you do for us. We appreciate it. For everybody that came, oh my goodness, it's a pleasure always to have you ask these questions, tough questions for me sometimes. And that's why I am diverting them to friends like Esther who can pick up some of those tough questions. Esther, we cannot thank you enough for what you have been doing for the community in Canada and what you are doing for us here. You're going to continue being a great resource. And I'll continue asking you to come over with ideas, the knowledge that you have. Somebody is going to benefit and take one step further in what they're doing. A word from you might turn their whole ship around and become way better in finance. And they'll remember, some days I had this presentation, I started taking it seriously. That's our goal. And I thank you so much, Esther, for doing this. I know we are doing—
You're welcome, Pete. You're welcome. And I'm thankful for you for having me. And I cannot overemphasize how this relationship is just divine. And so I'm so grateful. I just put everyone can see the presentation. I just put it on the comments. Make sure you download it before the presentation ends so that you have it. Yeah, so that's what I wanted to say. But thank you so much, Pete.
Thank you so much, Esther. All right, so go ahead and download that presentation if you need it. Download our class schedule if you are looking at taking a few classes in future. Any other information that was beneficial and you missed it or you want it, a recording for this will be available on Discord for our members. Just reach out to us and we'll get it to you. But we do appreciate you. Thank you so much. You're going to end here. I'm going to stop the recording. And then we'll just hang around for another couple minutes, just in case someone has a specific question.